A. Describe the term structure of interest rates and explain why it changes over time. The term structure of interest rates represents the relationship between bond yields and time to maturity. It is commonly illustrated by the yield curve, which may be upward sloping, normal, downward sloping, inverted, or flat. The shape reflects market expectations about future interest rates, inflation, and economic conditions. An upward sloping yield curve suggests expectations of economic growth and rising inflation. Investors demand higher yields for longer maturities to compensate for increased uncertainty and inflation risk. An inverted yield curve often signals expected economic slowdown or recession. Short-term rates exceed long-term rates due to tight monetary policy or declining growth expectations. The term structure changes due to monetary policy, inflation expectations, and supply-demand conditions in bond markets. Understanding these shifts is essential for financing, investing, and refinancing decisions. B. Define and identify the characteristics of common stock and preferred stock. Common stock represents ownership in a corporation and carries voting rights. Shareholders participate in corporate governance and benefit from residual profits after creditors and preferred shareholders are paid. Common shareholders receive dividends at the discretion of the board of directors. Dividends are not guaranteed and may fluctuate with profitability. Preferred stock has characteristics of both equity and debt. It generally pays fixed dividends and has priority over common stock in dividend payments and liquidation. Preferred shares typically do not carry voting rights. However, some may include cumulative dividend provisions or conversion features. Understanding differences between common and preferred stock helps evaluate capital structure and investor expectations. C. Identify and describe basic bond features. Maturity refers to the date when the bond's principal, par value, is repaid. Longer maturities typically carry higher interest rate risk. Par value is the amount repaid at maturity, and the coupon rate determines periodic interest payments. Market interest rates affect bond pricing relative to par. Redemption provisions allow issuers to call bonds before maturity. Callable bonds benefit issuers when rates decline, but increase investor reinvestment risk. Conversion provisions permit bondholders to convert debt into equity. Covenants and indentures define legal obligations and restrictions protecting investors. Options embedded in bonds influence pricing, risk, and required yield. D. Identify and evaluate debt issuance or refinancing strategies. Debt issuance decisions depend on interest rate conditions, credit rating, and capital structure goals. Firms may issue short-term or long-term debt depending on risk tolerance and market outlook. Refinancing involves replacing existing debt with new debt, often to lower interest costs. Companies may refinance when market rates decline or credit quality improves. Callable debt allows early repayment flexibility but may require higher initial interest rates. Management must evaluate call premiums and transaction costs. Debt maturity structure affects liquidity risk and financial flexibility. A balanced maturity profile reduces refinancing pressure. Effective debt strategy minimizes cost of capital while managing financial risk and maintaining solvency. E. Value bonds, common stock, and preferred stock using discounted cash flow methods. Bond valuation is based on the present value of future cash flows. These cash flows include periodic coupon payments and the repayment of par value at maturity, discounted at the market-required rate of return. When the required rate exceeds the coupon rate, the bond sells at a discount. When lower, it sells at a premium. Preferred stock valuation resembles a perpetuity model. Since preferred dividends are typically fixed and ongoing, value equals the dividend divided by the required rate of return. Common stock valuation applies. Dividend discount models, DDM. For constant growth firms, the Gordon Growth Model estimates price as next year's dividend divided by the difference between required return and growth rate. Discounted cash flow valuation reflects risk and time value of money. Higher required returns reduce asset value. Understanding DCF methods supports investment analysis and cost of capital estimation. F. Demonstrate understanding of duration as a measure of bond interest rate sensitivity. Duration measures a bond's sensitivity to interest rate changes. It estimates the percentage change in bond price for a given change in market interest rates, holding other factors constant. Longer duration implies greater price volatility. Bonds with longer maturities or lower coupon rates typically have higher duration and are more sensitive to rate fluctuations. Duration incorporates timing of cash flows. It reflects the weighted average time to receive the bond's payments. Investors and financial managers use duration to manage interest rate risk. Matching asset and liability durations can reduce exposure to rate changes. Understanding duration enhances fixed income portfolio management and refinancing decisions.